Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
All right, good afternoon, everyone. We're going to start off this afternoon's webinar. It is 4:30 p.m. here in New York. We are excited to have Al Brinkman for this afternoon's session, and he will be teaching us about straddles and strangles using ETFs. These are strategies for beginners. Just a brief introduction for those of you who are not familiar with Al. He is the principal of Brinkman Group and an education consultant with many years of experience in the trading world. Al is an exchange industry veteran with 20 years of experience at the Philadelphia Stock Exchange as an equity trading specialist and option floor broker. He is also a staff instructor for the Options Industry Council, conducting option education seminars all over the United States. So at this point, we're going to turn it over to Al for this afternoon's presentation.
Katrina, thank you very much. Are we okay here? Can you hear me?
Yep, I can hear you. Looks like everyone else can hear you as well.
Okay, good. Again, thank you for the kind introduction and welcome everybody. Thank you very much for taking time out of your busy schedules here on a Wednesday afternoon, especially with the weather looking as beautiful as it is, at least where I am. Anyway, at this point in time, and I hope we provide some good information here and some food for thought in looking at two option strategies that are very, very similar to each other, straddles and strangles. They both fit into playing volatility, and I'm going to get a little more into that because I was thinking about this as I was putting this presentation together, and we use the term volatility in the stock market and obviously in the options part of that quite extensively and kind of paint it with a broad brush a little bit. And I think we need to step back a little bit here when we look at this particular strategy or any option strategy where obviously volatility comes into play no matter what we do. But put it in context of current market conditions that we've had recently, where we've had these incredibly volatile days where we're up a lot, down a lot, turn on a dime, move back, change. We're not exactly sure what's coming next because we don't know what the next news item is going to be. And the thought process I went through looking at this was that may not be the time to execute this type of strategy. And I think that'll come clear as we move through this a little bit. But I want you to keep that in mind, that we need to kind of separate that market volatility from a particular underlying for a particular reason, which is, again, where we're going to roll into the strategy here, straddles and strangles. So before we get started, we've always got to get the lawyers their due. So we've got to have a couple of dozen disclaimers in here. So at your leisure, please take a moment to read these. Particularly if you have any trouble getting to sleep at night, pull these bad boys out, read them, and guaranteed you're going to go out. They are, the standard disclaimers, of course. Obviously, options involve risks, and I think everybody, hopefully here, has been involved in options a little bit and wants to expand their knowledge, so they know that. Let me start out real quick here, because we're looking at this kind of molding it in with exchange-traded funds a little bit about some fundamentals or primer on exchange-traded funds themselves and how I would approach using these and trying to put on a strategy. Any option strategy, we're going to focus on straddles and strangles. But anyway, let's understand the ETFs that we're looking at using. And remember that the ETF is really an account structure, not a strategy in and of themselves. They're designed to cover something. They have an index that covers a broad-based market, a narrow piece of the market, a specific segment of the market. I think we need to understand that structure, what's built into it. Is it a broad market index? That kind of changes our approach to what we're looking for. And when you get into the selecting your straddle, looking for the candidate for a straddle, I think you'll see how this plays into this a little bit. Or is it what I would call a customized index? Is it specifically on a market segment? Is it something on a particular industry, be it semiconductors, be it gold, that type of thing, or gold and silver? And that has actually expanded over the years now, clearly into just gold rather than gold companies, that type of thing. Another issue to look at for the ETF, and I think this really comes into play, is the security is put in the index, and an ETF is essentially an index built out that way. How are they selected to be part of that? And then in the index itself, how are they weighted? You know, does 2 or 3 companies in that ETF that covers the particular industry, the copper industry, or whatever it may be, are 2 or 3 of those perhaps weighted more heavily in the index, which means that their movements and their volatility are going to impact the way that ETF pricing moves. And that in turn impacts the risk-return characteristics of the overall index. And when you're looking at deciding on an ETF to play out the straddle strategy, this is something to seriously look at, because you may look and say, you know what, I may be better off at this point moving to the individual stock as opposed to the ETF. This is kind of the decision process. This is, you know, like anything else, it requires some research and thought. Obviously, growth in ETFs over the past years has been explosive and doesn't look like it's slowing down at any time. We have broad U.S. equity markets. We have style ETFs, small cap, mid cap. I kind of tongue-in-cheek put large and kind of small, and then a few mid cap in it, kind of tongue-in-cheek here that they're doing with this, because they're covering just about every spectrum that you and I can think of. Global equity gives us access here. This moves things out that we can trade across the globe. Specific industry ETFs, obviously the special ETFs, fixed income, country-specific, commodity-specific, and currency-specific. And these open up some interesting possibilities we're going to talk about as we go through this, as we go on. And of course, then there's the leveraged ETFs that are out there, the double up, double down, and so on, all those structures. Not sure that they play extremely well into a straddle and strangle, because the strategy baseline is we're trying to take advantage of a move in the market place, but we're not exactly sure which direction it's going to go. And if we're looking at leverage 2 up or 2 down, we pretty much have an idea of where we think it's going to go, and we want to take advantage of that. So just saying, new structures, new types every day, it requires some homework. So let's consider selecting the ETF and the ETF options we want to trade. The name of the game in the business is liquidity. We want to look at that underlying ETF and see what it has in trading volumes. And once again, we've narrowed our field a little bit because we've made a decision that we think a particular industry or a particular event is going to impact the market. So we looked at the ETFs that are available, and there are multiple ones on the same thing. So you may need to look and see what are the trading volumes, because does it have liquidity under it? Does this particular index reflect that situation? Are we looking for broad market exposure? Are we looking for something that we think the broad market is going to be explosive up or down? Specific sector, oil, natural resources, agriculture. Are we looking to try to play earnings season? Are we looking to play particular news events that are out there that we're not sure exactly how they're going to impact the market, but we're pretty sure they are going to impact the market in a major way? Alternative options, and I guess I'm being pardon the pun there, but it really does come into play because there are so many different ETF structures out there. If maybe we end up playing the specific commodity ETF here in our straddle, rather than something that may be a regional or a sector that has a lot of companies that are involved in, let's say, the copper industry. We just want to play the cash copper, for example, in dealing with the materials if we think that's where we want to go. And then once we've decided and looked at it and said, okay, this particular ETF definitely has some trading volume, we want to look at the options and see if they in fact have liquidity, because that impacts a lot of things, particularly in these two strategies, where your market spreads between the bid-offer spread and the particular options. The more liquidity we have, clearly the closer in they're going to be. And that impacts our risk-reward profile for the particular strategy. And once again, trading volumes, do they actually trade? Are there enough volume in here? Can I get in? Can I get out at a reasonable price put together? I don't want to get caught having a great trade and find my market spread way far apart and take a lot off the table because of the bid-offer spread in the particular options. I would caution that there are some ETFs that you might say, hey, look at this, it has plenty of volume. I would take a minute and make sure that volume is consistent not limited to a specific narrow time frame. Some of them have bursts of activity in them, I've noticed. And again, the options must have that liquidity. Quick word about volatility. After all, we're looking at volatility here. These are volatility strategies. So, simplest terms, the degree to which the price of an underlying instrument tends to fluctuate over time. So it is a measure of risk. If we use volatility as risk interchangeably, I think people get a better picture of what it is. Always keep in mind volatility is not directional. People have somewhat of a tendency to think volatility, again, they look at it as maybe it's solid, which is going to go up a lot. No, volatility can be up or down, directional, as we see in the marketplace in general. However, when we're dealing in the option scenario, and we come up higher volatilities, we are going to get wider, faster price swings. That translates to a greater risk in the market. And thinking now about the person perhaps making the markets in these options, they're assuming greater risk because of higher volatility. Option premiums, because the volatility is part of the options calculation. Premium excuse me for a second there, kind of just derailed a second. Our option premiums are going to be more expensive. That really impacts the risk-reward picture for a straddle or a strangle. So let's take a look. Let's set the stage here, and we'll move from there on that. Let's set the stage by saying what's the long straddle. And we're going to work from the long side for most of this presentation, and I'll elaborate on why that is when we get to the end. Long straddle, very simply, we're buying one call and one put. It's got the same strike price. It has the same underlying ETF, security, whatever, and the same expiration date. We are literally straddling the market. Long the call to the upside, long the put to the downside. Our risk profile, as we set this up, our maximum risk is what we paid for it. Remember, just the standard. We buy an option, we've established our risk, what we paid for it. So in this case, we have the net debit because we are buying two options. Our maximum reward, we use the term unlimited here, and then the last it says, well, you're unlimited to the upside of the long call. Now, really probably should say until the call expires, of course, and then put we would be limited for our reward, such as the underlying goes to zero. Let's say it goes to zero within the time frame that we straddled on, put the straddle on, but I wouldn't count on that part of things. But we do have a substantial opportunity for reward on this. Because we have two options, we're going to have a downside and an upside break even. Our net debit sets the stage for that. So it's our strike price, less net debit on the downside before we break into plus territory, and then the upside is strike price plus net debit. Scenarios, multiple scenarios. Just give you a couple here real quick before we get into walking through some examples and some other things on the straddles and strangles. In a scenario, let's just call it A. We have bullish news and we're looking for the exchange-traded fund, the ETF. Right. So we're going to profit from the realized volatility as that volatility builds in and increases on that. Scenario B, we have bearish news, the ETF declines. We can profit from realized volatility and from implied volatility because that's going to come out and our options are going to change in price. And implied volatility can come up, bearish news as well. Scenario C, we have a non-event. We're looking to do news in this case. And this is clearly the worst scenario because we're on two options. We're going to lose on the time decay in those options. And we're also going to lose because of implied volatility. Since there is no news, there's no need for increased volatility in the option or risk premium, if you will. And that's going to come out as well. And once again, a little more detail as we go in. Let's just go through a quick example and work the numbers on the long straddle. With underlying ETF trading at $50, we're going to buy the 50 call at $3.20, and we're going to buy the 50 put at $3. Net cost of this trade is $6.20, our net debit. So we're doing an at-the-money 50 straddle for 620 plus commissions. So let's do a real quick risk analysis for this. We need to do that. We have the 2 points for the break-even, strike plus net debit, 50 plus 620. So we need to break through 5620, and on the downside, we need to get through 4380 to start taking in profit. What if our find a token for the straddle in this position? Either the ETF explodes to the upside or sinks like a rock. Again, it is a volatility play, and we're looking for something to move this. The reason we've done the straddle is we know it's going to move. We're confident that it's going to move based on our analysis, but we're just not sure which way it's going to go. And I think you can see that happen a lot, and I'll talk about that when we talk about the selecting the straddle. So what's our potential here? Well, once again, theoretically unlimited on the upside, substantial on the downside, limited to the strike minus the debit. Literally 4380 is a number on this one that we can possibly make out of this. Time decay. Major factor here, because at the beginning when I did the example, I didn't put a time limit on when we months out. We really need to think about that, because we are long 2 options on time decay in a straddle or a strangle position is double down, because we're taking a hit on both sides of the trade. Implied volatility, however, is our friend, increases value of both of these options. Remember, it's non-directional, and suggests that maybe a nice price swing may be coming as implied volatility comes in to the trade. Let's just do a real quick table to set the stage for the numbers. Just again, pure example. All right, so we have a profit and loss table. We have the ETF price, and I just happen to go 60 to 40. This can go on or down to a number on it. This just gives you a picture of what's going on. So with price at 60, 50 call has profit, 55 call has more profit into it, and we can see on the downside now, from 50 to down, we've got a downside picture. On the put side, we flip it, obviously, if we're doing it at 60 and 40, they have a plus on the upside. And really, get you back in this whole thing right out here with the combined. You see on the wings out here, as we start to get the move, is where we start to put in profit. On both sides, how we would get it, a 40 down or a 60 up, about a 20% move. And the key in here to remember is that you still can get a movement in the underlying stock, but you still cannot get out of that cost issue. You still have that 620 in this case that you have to make up. So you can still get a move. That's why in the straddle, the move is rocket, rock. Lousy handwriting, sorry, excuse me. That's what we need to do on those. So let's just take a look through the old hockey stick diagram, and you can see it pretty much here. I'm going to fill this thing right in real quick on the material. So in this case, this is our at-the-money strike, and then we've got the directional, and of course, down to 0 on this side. This would be if you wanted an ETF position, because once again, we're long, so we have the ability to get a physical position in the ETF. We can get the short ETF here on the put side, exercise at 50 put. This is once again, let's say we start to move to close to the expiration of the option. We still have time decay to think about that we're losing, even though we've made money. We're still going to be chopping away time value on our profit. You may say, you know what, let's close out the position by exercising it. And we do think that this still has some downside. Same scenario over here. We think we have some continued upside for the option, but we're getting close to the option expiration, perhaps, that we put the trade on, and we are taking some incoming hits from the time decay. What about solo options versus the long straddle? Well, here I put together a little bit of a chart again to show you some of the different things. So here we have the ETF price moving from 50 to 60, 20% change. We've moved our days from expiration down. If we had done the 50 call, using our number of 320, now at 60 is worth 1020, and that's a very substantial, certainly very, very substantial, very positive rise from that. The flip side of the trade, of course, the downside, if we're going from 50 to 60, if it did it to 40, we'd have a flip side here. If we do the straddle, we've had a substantial, a reasonable profit within 20% margin. We're up 67, certainly not the 220 here. But once again, let's recall, why are we doing this? It's because I'm not sure it was going to do that. If clearly we were very, very bullish, very, very bearish, that points us in the direction for a different strategy. And that's the beauty of the options. We can certainly maneuver those to do different things. So that's a real quick overview of the basic numbers and stuff on the straddle strategy. Let's take a look now at a variation on the theme, and let's go to the long straddle. There we go. All right. I got a couple of questions here. I'm going to stop off for a second and go back. I got one on how do we determine if the option has the required liquidity. You're going to need to look at volume and open interest over a period of time to see that it does in fact trade. Options, sometimes they fall in and out of favor and they don't trade for a day or two, where they trade lower numbers. But you just need to see a consistent pattern of decent volume. Hard number to pick out, but certainly if you're trading 10 or 15 contracts today, that may not be the number you're looking at on that. But you want to look at something that's got, that is trading. And clearly, activity, we're talking here for the straddle anyway, looking at the at-the-money strike prices. They're really where it's going to be, the at-the-money near months, where the volume's going to be hitting anyway. So you'll get a pretty good picture right away. If there's no volume and you're within 3 months and you're at the money strike and there's very, very little volume, that tells me that it might be a difficult time to get that in my pricing, bid offer spread. That's the other way to look at that as well. Just look at what that bid offer spread is out there. It looks like it's too far apart. Thinking about the cost. And we're going to get more into selecting that in just a few seconds as we go through. So let's talk about the long strangle, just to set up the stage for the variation. Now this requires the same basic deal for the long side. We're purchasing a call, we're purchasing a put. The difference is the put's going to have a lower strike price. Once again, same underlying, same expiration date. Let's do it again. ETFs trading at 50. In this case, we're going to go to the 55 call. Right, we're going to move up and we're going to move down a little here. We're going to do the 45, so we're pushing our strike prices out a little bit. What has happened is clearly, because we've done that, moving out of the money, we've done it for a lot less cost. Remember? We did that other one for $6 on the at-the-money deals. So the strike prices are separate. We've reduced the cost using those out-of-the monies. We are going to have now more of a move. We're already looking. It's at 50. It needs to get to 55 so that even get in the money. So we've got that kind of built in there type of thing. Break even stays the same. Strike price minus net debit on the downside and on the upside. Our fondest hope will still be that the ETF explodes to the upside or things like that. Our potential remains exactly the same. Our time decay, double down villain, remains exactly the same. And once again, implied volatility stays the same. Once again, right out here is where we're starting to look at where we get a little bit of a difference. If we reduce the cost to do this. Perhaps this idea is something that we really think it's going to be an explosive move, and we're willing to sacrifice. It's kind of like the deductible, if you will. We're willing to sacrifice by moving out, by paying a little less because we put a bigger deductible on our insurance policies. Once again, we'll do the chart at expiration. This is how the call would play out, how the put would play out, and when we put it together, we do that. So you can see out here that we have numbers out here. Once again, we have that larger premium loss, more opportunity to lose the entire premium. If we go back to the straddle table, you'll see that you're not losing the entire amount. Okay, your loss is a little bit less. It's still going to be your whole game plan in here. These two numbers, prices you paid are going to be here. If we run back to the straddle table, you'll notice that it's not quite as much. You're still going to lose, but it wouldn't be the entire premium. do the diagram, and you can certainly see the setup on these. Okay, we go back one. I kind of went through that. You've got this wire range where you could experience a larger total loss. Okay, because you push those strike prices out because you need this movement from here to here to start things starting to happen. Once again, you can get short the ETF, you can get long the ETF on the outside of the wings. And I really have got a fast clicker, and I apologize for that. I haven't been doing a couple of these for a while, so I have to get back in the swing. All right. So you'd exercise expires. Once again, you don't have to do that. Remember, you can certainly close out the positions and move on to the next trade. And we're going to touch on another angle at exiting the trade here before we finish today. Strangles versus solo options. We do the same numbers we did before. We do the 50 to 60. We drop it 52 days left. The 55 call in this case. Now, moving has a greater swing. Nice return, but once again, the issue here is we didn't know that was going to happen. If we did, we wouldn't have done all this stuff down here on the bottom part. But now, with the investment here, we get the substantial move on a percentage basis, not a net dollar basis, but on a percentage basis. We've got a really nice return on that. Once again, not always recommending straddles and strangles. It's kind of, once again, falls into your view of what that underlying is going to do, how explosive that move is going to be. So, just as a real quick summary, straddles, higher cost and lower leverage. All right, I get some stuff here. I'm fading in and out. I'm going to try to hold this much closer and keep it. That's what's happening. It's moving away a little bit. So here we go. Higher cost and lower leverage. Break-even points are going to be closer together, so you have less of a need in the underlying to move sharply to get through the break-even. That means there's less chance of 100% loss. Higher leverage, but lower cost. But your break-even is hanging out there a little bit, which leads to a greater chance for 100% loss if, in fact, the movement does not occur within a timely manner. Let's just compare them, and I think you'll really see it here. We've got the strangle, and we've got the straddle somewhere in here. There we go. Comes in. You can definitely see. We've got, as I said, we've got this out here, these out here, and then this one's a sharper move in the direction. They're the two basic strategies. They're relatively easy. Again, long call, long put, a little bit of strike price out, a little bit in.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.